My name is BJ Phengmanivanh. My partner is Mark Anderson, and for the 2019 Principal Financial Group Stock Pitch Competition, we're pitching Home Depot. So, on my part, I'll be going over Home Depot's historical background, who they are, who their competitions are, and what their plan is. Mark in depth about Home Depot later on. So, Home Depot is one of the largest home improvement retail stores in America. They specialize in selling tools, construction products, and services for their customers who choose to go into the store or shop on their online website. So, they're listed as part of Dow Jones Industrial Average. Their consumer discretionary is specialty and retail. They have a 228 billion market cap, and their current price that they closed on last Friday was 203.61. So Home Depot does have a strategic vision. Their number one vision here is what they call creating one Home Depot. In 2018, they invested their own cash or money, 11 billion of it, into their stores, their workers, their digital experience for customers, and towards their own supply chain. So what they did was they really on their online sales, they really concentrated on that. Beginning of last year, they implemented 1.2 billion for 5 years of a commitment to their supply chain that will allow same day or next day delivery for 90% of the US population. So that goes back to this online sales. They're really trying to drive that so that way they can up their sales on that, because last year they had most of their revenue come from online. That really implements that most of their customers don't want to go into the stores, they just really want online sales. Another thing they're really focusing on is product authority. So it's sourcing of their best products for do-it-yourself and professional customers. ESG is another thing that they're focusing on. They're really trying to stand out from their normal brick and mortar store. ESG stands for environmental, social, and governance. So last year in 2018, there was a lot of hurricanes and storms that really took thousands of customers' homes away, and Home Depot is a store that really helps with implementing new things to your house, so home improvement, things like that. So what they did was they put 500 million of their own assets to veteran causes for 2020 until 2025. They put 50 million committed to train 20K tradespeople within the next decade, and also CDP named Home Depot its A-list in regarding for environmental impact. So let me just move this here. The difference between Lowe's and Home Depot in the market right now. As of right now, Lowe's, they have a slow growth within the past 5 years, while Home Depot, they had a good 5 years of growth, revenue growth that is. So since 2013, Lowe's here has only gotten a 26.8 revenue growth, and then Home Depot has gotten a 30. Now, it's not that far off, but here's where the big difference is. Lowe's had an aggressive store opening since 2013. They've opened 320 new stores from 2013 to 2017. Within those 4 years, that's how many stores have been opened. So 51 of those stores closed in 2018 due to underperformance. That just shows that 51 of those stores weren't bringing in enough revenue for Lowe's to stay open. Now, Home Depot on the other side, they have little to no stores opening in the U.S. For the past 2013, since 2016, they had no stores. 2016 to 2018, they had 4 locations. Now, the difference between the two, that's 316 stores with 30% revenue growth towards Home Depot. Lowe's forward dividend yield is 1.75%. They have a 10 billion stock buyback announced in the first quarter of 2018, and 2018 their payout ratio is 38.6, which isn't bad. On the other hand, Home Depot here, they have a returning value to shareholders, 14.7 billion returned shareholders in 2018 through dividends and buybacks, for dividend yield of 2.83, and their payout ratio is 48.6. So Home Depot here, they have a bigger payout ratio. Of course, their percentage is higher than Lowe's, which means that more investors will earn more dividends through Home Depot than Lowe's.
Taking a deeper dive into Home Depot, many companies face business risks outside of their day-to-day control when it comes to the economy and the political environment. Home Depot is not immune to this and is tied to these risks potentially more so than others. The strongest of these in our analysis are the housing market, specifically the home improvement market, strength of the economy, and of course interest rates. The following are major indicators that we have labeled as important to track when it comes to knowing the pulse of the housing market. First up is new home sales. What it is, it's a monthly indicator that measures the number of newly constructed homes with a committed sale during that month. It's important as it shows economic momentum as buyers coming in with expectations of the future. Future for Home Depot being those service and product offerings such as flooring, cabinets, windows, furnaces, and central air systems for those professional service companies, third-party contractors, the do-it-yourself customers. Good news for us, the recent report was bullish, beating expectations of 645K consensus versus 692 actual. And as you can see by the chart on the right-hand side of the screen, it may indicate that lowering interest rates have a favorable impact there as they have been there at their lowest since November of 2017. Second up is residential construction or housing starts. It's registered at the start of construction of a new building, primarily residential. So again, what Home Depot benefits from this is those professional workers coming in and using their goods and services, such as those building materials, windows, flooring, and even landscape and home good products. All can be a benefit to the company. The reading, as we see there under the table, both starts and permits came in below expectations. We feel this is due to lingering effects of poor GDP expectations, economic fears lingering in the news, government shutdown, and the rising interest rate environment that was happening near the end of 2018. So we take that with a little bit of grain of salt. Third up is the National Association of Home Builders, or NAHB. This is an organization that produces housing statistics on the national, regional, and metro market levels. Builders' confidence here is referring to newly built single-family homes. They ask builders' perceptions on the market as good, fair, or poor. A reading above 50 signals conditions are viewed as good rather than poor. And the building confidence in April rose to 63, and sales conditions also increased 1 point to 69. So both of those are bullish readings, positive for Home Depot. Next up, just to take myself off the screen for a minute so we can see the slide better. Other factors mentioned for the general economy, GDP or gross domestic product, which measures the overall health of our economy, such as purchases of domestically produced goods and services. GDP came in much stronger than expected of 3.2 versus 2.3 for real, respectively. However, we feel that it is important to point out that residential investment was a lagger in this area, actually subtracting 11 basis points from this number. So while the economy is in better shape than expected, the housing market still has room to improve, we believe. We actually view this as a potential upside for Home Depot. Number two would be the employment situation. Again, while there has been concerns of a slowdown, the job market remains solid under President Trump. Non-farm payroll rose again in the last indicator, and unemployment rates still coming in at expectations, all still near all-time lows. One concern for us to watch for is the wages remaining a little bit stagnant. And lastly, the interest rate environment. The federal funds rate is the most important or most significant leading economic indicator, directly affects things for everyday Americans such as their savings, purchases, and most loans. Higher interest rate environment will make borrowing more expensive. Savings will increase, which is not a good sign for Home Depot. But we do like the dovish tone the Fed has set lately, and hope interest rates continue to not climb as they set that target to remain until 2021. This sentiment would be very good for Home Depot, especially with their balance sheet as they carry a lot of debt, which we'll get into later. Now, focusing on what Home Depot actually has control over, their financial performance. First, we want to touch on financial weaknesses for Home Depot. First up is their working capital. We've seen it gone down each of the last 5 years for their annual reporting, actually. This is a major ratio which measures the liquidity of a company for its short-term financial health. As you can see, a little over $4 billion in 2014 compared to now about $2.7 billion in 2018. This is because Home Depot has taken on a lot of debt in the last 5 years, specifically long-term debt, which has actually led to an unstable debt-to-equity ratio. You can see incrementally how much debt they've taken on year over year. And in that far left-hand column, negative stockholder equity has actually given them a negative ROE, return on equity ratio. But what we want to point out is that we believe Home Depot actually has a lot of financial strengths. They're actually a financially sound company, and they've used this debt appropriately. It's actually served investors really well as it has appropriate cash flow to support it. So again, we believe Home Depot to be a very financially sound company. The first two things we want to talk about is the return on assets and return on invested capital. ROA shows how well a company is using its assets to create earnings, which Home Depot has been able to do well, boasting a 27% ROA. Typically, reading above 20 is positive for investors. Return on invested capital gives a good sense of how well a company is using its money to generate returns. It's used as a great benchmark to measure value, and typically a reading above 2% there shows that a company is creating value. And Home Depot has actually increased this number each of the last decade, over the last 10 years, currently sitting at 34% right now. And then again, that 45% payout ratio, they pay a really healthy dividend, which is attractive to investors. Improving inventory turnover, with Home Depot stating in their annual report that they wanted to focus on the concept of one Home Depot, increase investments in the supply chain management, getting their products to consumers faster. They actually say online sales, they want to be able to deliver to those customers, 90% of them in one day. So it's important for us here to see an improved inventory turnover, which Home Depot has been able to do steadily over the years. Seen a slight dip in 2019, but still very positive that we've seen it increase. And then the conversation on debt. Taking a sample from 2018 to show that Home Depot produces enough cash relative to its debt, with $3 billion in cash and short-term investments, $3 billion of short-term investments. I apologize, and a little over $12 billion in cash from operating activities. Operating cash flow to debt is about 44.5%, greater than 20% of the debt. So again, that's positive. And furthermore, it's not unusual for a large cap company such as Home Depot to be highly leveraged, as interest payments are tax deductible. If a company can generate enough earnings before interest and tax, their EBIT, 3 times its net interest payments, it's considered financially sound. And Home Depot is well above this, boasting a 16.5 times that number. So again, we believe that the cash is enough to cover that debt, and it's not overly a concern for us. Again, I'll remove myself from the screen so we can see the next slide. To further back up our analysis, Home Depot delivers solid earnings historically. We wanted to compare how investors have compared from an earnings perspective to the overall market and the specialty retail section. And again, the example we like to use is a main competitor, Lowe's. It has been able to outpace the overall market and the specialty retail sector and its main competitor, Lowe's, over the last year and the last 5 years. Lowe's has been unable to match this performance and actually delivered a negative 32.9% earnings this last year. So again, in the specialty retail section, we believe Home Depot is the stock to own. From a historical perspective, this time from a price standpoint, Home Depot has fared very strongly in the last 5 years. If you look on the right-hand side, it's been able to outpace Lowe's, the Dow Jones U.S. Specialty Retailers Index, and the S&P 500 in the last 5 years. On the right-hand side, again, it's been able to outpace Lowe's and the S&P 500. Returns for the Specialty Retailers Index came a little bit higher in the last 3 years. But again, if you were able to be a long-term investor in Home Depot, you've seen great returns outpacing the market and major competitors, and we hope and expect that to continue in the future. Now, jumping over to our valuation portion of our presentation, a small explanation of how we reached our results. The table in the top left-hand corner, the tax rate was taken from Home Depot's most recent annual report. The debt-to-equity ratio was taken from our calculations on a previous slide. The risk-free rate was sourced from Y charts, and it is the current 10-year government bond rate. The equity risk premium was taken from S&P Global and Simply Wall Street. Specialty retail unlevered beta was again taken from Simply Wall Street and S&P Global. The relevered beta was from our own calculations based on the inputs. The discount rate also again from our own calculations based on our inputs. And the shares outstanding was from NASDAQ.com. The calculations below outline how an intrinsic value for Home Depot is arrived at by discounting future cash flows to their present value using the two-stage method. We tried to start with analyst estimates of free cash flow and then use what we believe to be moderate growth estimates for those last 4 years. The table at the bottom of the screen. In the first stage, We continue to grow free cash flow over a 10-year period to arrive at our present value of the next 10 years of free cash flows coming in down here at that bottom right-hand corner. And on the right-hand side, terminal value, present value of terminal value, total equity value. Again, until we reach what we believe the present value of the stock to be worth. The growth rate is trending towards the perpetual growth rate used in the second stage. The second stage assumes that a company grows at a stable rate in perpetuity. And through our calculations and forecasts, we believe that Home Depot is undervalued by a little under 2% based on the current trading price, and we view this as an attractive buying opportunity. We recommend just that. We believe that Home Depot is the specialty retail stock to own in the home improvement sector. Their concentrated growth on one Home Depot, making purchases easier for customers, integrating that online experience with that in-store experience, actually driving sales online, is one that will help them beat out competition in the future, as well as keep them Amazon-proof, which is really important in this environment. But with current headwinds in the housing market, a little bit of uncertainty, we expect a small price correction, but we still recommend to buy before the spring and gardening and home improvement numbers factor in for Q3. And from a technical perspective, combined with our valuation perspective, we recommend to buy at $194. Thank you.